Good afternoon, sir, and to everybody. I am Precious Ann Makiling, and I am the first reporter of Group 3, and we will be discussing about the swaps and its types, caps and floors, and the stock options. But before we go further to the proper discussion, let me read to you, or please allow me to read our learning objectives. So first is we are going to identify the swaps, the types of swaps, and the relationship between the caps, floors, and the options. Second learning objective is we are going to identify the basic features of stock options, the different stock option strategies, and the price strategies of the stock option market. So I will be your first reporter. So without further ado, let's start. Now, what do we mean when we say swaps? When we say swaps, these are the derivative instruments that represents an agreement between two parties to exchange a series of cash flows over a specific period of time. This offers a great flexibility in designing and structuring contracts based on the mutual agreement, and this flexibility generates many swaps variations or different types of variations, with each serving a specific purpose, or each of those types of the swaps has different purpose. So in other words, when we say swaps, this refers or this pertains to the agreement of the two parties to exchange a series of cash flows over a specific period of time. And with this flexibility is nahati siya into into many types of variations of swaps. Each has different purpose or different goal in a specific swap. So talking about the types of swaps, we have first the interest rate swaps. When we say interest rate swaps, this is the most popular type of swaps, which allows two parties to exchange fixed and floating cash flows on an interest-bearing investment or plans. Now, what do we mean when we say floating cash flows? From the word itself, floating, and the word cash flow, this refers to the time lag between a payment is received by a business and when it is available for use or ready for withdrawal. Next type of swap is what we call as the currency swaps. When we say currency swaps, this is a transactional value of capital that changes hands in currency markets, surpasses that all other markets, and this offers an efficient ways to hedge forex risk or foreign exchange risk. From the word itself, currency, so currency swap is a type of transactional value of capital that changes hands in immense. And the currency swaps, as what have been mentioned earlier, this offers ways to hedge foreign exchange risk by allowing parties to engage cash flows using different type of currencies. Mo na siya gitawag siya na currency swaps. Now, on the other hand, when we say commodity swaps, this is common among individuals or companies that use raw materials to produce goods or finished products, allows receipt of payment linked to the commodity price against a fixed rate. So kung sa currency swap is allow ang two parties to exchange using different type of currencies, sa commodity swaps naman, from the word itself commodity, is ang two parties is nag-agree sila na mag-exchange ng different types of mga commodities. This refers to the finished products, raw materials, and anything na maagreehan nila to be part of the commodity in their agreement for exchange. Moving on, another type of swap is what we call as the credit default swaps. This offers insurance in case of default by a third-party borrower. So when we say credit default swaps or the CDS, from the word itself, this offers an issuance in case nga ma-default ang isa ka third party nga borrower One party will pay a periodic fee to the other party in exchange for a payoff if a specific credit event like default ang mo-occur. So this is crucial especially for managing the credit risk. So fifth type of swap is what we call as the zero coupon swaps. Zero coupon swaps by definition, this is similar to the interest rate swap, and this swap offers as well an flexibility to one of the parties in the swap transactions. And in a fixed to floating zero coupon swap, the fixed rate cash flows are not paid periodically, but just once at the end of the maturity of the swap contract. So kaning zero coupon swap is dili siya payable, or this is not paid periodically, but this is only paid once and at the end of the maturity lang of a specific swap contract. So next one is the total return swaps. When we say total return swaps, this gives an investor the benefits of owning securities without actual ownership. Contract between a total return payer and a total return receiver. So total return swaps is it will give the investors the benefits of owning securities, pero doesn't mean na they have an ownership of a specific securities. Other definition, when we say total return swaps, this contract involves the return payer and the return receiver, where the receiver gets the total return of a specific asset, including the income and the capital gains, while the payer naman is will receive the fixed or the floating rate payment. Mo na siya ang total return swap. So those are the types of swaps. We have three. To recap, we have the interest rate swaps, we have the currency swaps, the commodity swaps, the credit default swaps, and the zero coupon swaps, and lastly is the total return swaps. And now let's proceed to the next topic that we will be discussing in relation to our first objective, which is the cap and floor option. So in this area, we will be comparing what do we mean when we say cap and when we say floors. In layman's term, ang cap is yaon siya sa taas, while ang floor sa baba. So definitely, the definitions of these two will just be literal, and we will understand that later on as we give or as we provide the definition of these two, nganong literal lang siya pagkasabot when we say caps and floors in accordance to their positions sa ato ang real life. So first, we have the caps. So when we say caps, by definition, this refers to the agreements between two parties whereby one party for an upfront fees agrees to compensate the other if a designated interest or called the reference rate exceeds a predetermined level. So sa caps ko no, diba, as what I've mentioned a while ago, caps meaning taas. Na nga taas, this means this refers na ang reference rate ko no, if mag-exceed siya or mutaas sa predetermined level, or what do we call as the reference rate, is ang isa ka party is willing siya mo-compensate sa other na party in respond to the changes or ang pag-exceed sa interest rate on the predetermined level sa reference rate. But of course, naagihapon na siya agreement between the two parties. Kay under lang man gihapon ni siya sa swap, so this or there exists an agreement between the two parties. Now, on the other hand naman, when we say floors, sa baba or baba siya. So, there's still an agreement between two parties whereby ang isa ka party for an upfront fees is mag-agree siya na mag-compensate to the other party if ang reference rate naman this time is below the predetermined rate or what we call as the reference rate. So kibalik-kabaliktaran siya sa first one kaina, which is the cap. Kay sa cap is ang naagrihan sa duha ka party is ready mo compensate ang isa ka party sa isa ka party sub na iyahang naagrihan if ang designated rate or the reference rate exceeds or mutaas pa siya sa predetermined level. While on the other hand, sa floors naman is ang duha ka party is they agreed to compensate one another if the reference rate or the designated interest rate is mo go below the predetermined level. So that's the difference between the two. And in summary, the swaps and their variants, like itong mga variations or mga different types of swaps, we have the interest rate swaps, the currency swaps, commodity swaps, credit default swaps, the zero coupon swaps, and the total return swaps, including the caps and floors. The caps and floor options they offer a versatile tools, especially for managing financial risk, optimizing investment strategies, and also ensuring more predictable financial outcomes, whether dealing with interest rates man, currencies, commodities, or credit risk. Swaps provide tailored solutions para ma-meet ang isa ka specific na need in terms of financial. So, I guess that concludes my part of the report. I will give the floor now on the discussion to my other other group mates. Thank you.
Good day everyone, and sir, I am Leia Kanda, and continuing Ms. Makiling's discussion, stock options are financial instruments that give the holder the right but not the obligation to buy or sell a specific amount of a stock at a predetermined price within a specified time frame. In capital markets, stock options are commonly used as a form of derivative securities, providing investors the opportunity to speculate on the price movement of a stock without actually owning the underlying assets. So these are sort of alternative pay offered by some organizations, notably many startups, as part of their employee benefit projects. So there are two types in stock options. First, we have call options, which gives the holder the right to buy a specific amount of a stock at a predetermined price known as the strike price before the option expires. Second, put options, which gives the holder the right to sell a specific amount of a stock at a predetermined price before the option expires. So stock options are traded on exchanges and can be used for various purposes, including speculations, hedging, and generating income through option premiums. And it is important for investors to understand the risk and potential rewards associated with trading stocks, as they can be highly leveraged and may result in significant losses if not managed properly. Stock options have several key features that investors need to understand before trading them. So here are the basic features of stock options. First, we have expiration date. So every stock options has an expiration date, also known as expiry date. This is the date by which the option must be exercised if it is profitable, or it will be expire worthless. After the expiration date, the option ceases to exist, and the holder no longer has the right to buy or sell the underlying stock. Second, strike price. The strike price, also referred to as the exercise price, it is the price at which the underlying stock can be bought or sold when the option is exercised. It is predetermined at the time the option contract is created and remains fixed throughout the option's lifespan. Third, contract size. The contract size represents the amount of the underlying asset that is covered by a single options contract. In the case of stock options, one contract typically represents 100 shares of the underlying stocks. This means that if an investor buys one call option contract, they have the right to buy 100 shares of the stock at the specified strike price. Fourth, premium. The premium is the price that the option buyer pays to the option seller for the right to buy or sell the underlying stock. It is determined by various factors including the stock price, volatility, time to expiration, and the interest rate.
So, good morning, everyone. Good morning, sir. My name is Domingo Morta, and I will be discussing the stock option strategies. So, there are 10 different sorts of stock option strategies. However, the topic assigned to me is there are three. Um, First is covered call, second is married pot, and bull call spreads. So, first is what is covered call? So, covered call you purchase the underlying stock as you normally would and simultaneously write or sell a call option on those shares. So, a covered call is a fundamental option trading strategy where an investor sell a call option for every 100 shares of their underlying stock. So this strategy, also known as going short, also non-investors to earn income from their stock holdings by hedging their position by selling a portion of the stock upside potential for a specified period in exchange for the premium received. And then mitigate risk by owning the underlying stock and limiting potential and losses and allowing investors to generate income through the premium received from selling the call options. So overall, covered call strategy provides investor with a way to generate income from their stock holdings while managing risk. So it involves sacrificing some of the stock upside potential in exchange for the option premium, offering a balance between income generation and risk mitigation in the option market. So here is some example. So you buy 100 shares of XYZ company at $50 per share. So you sell one call option with a strike price of $50 for a premium of 2 per share. So the outcomes is if the stock price stays below $50, the call options expire worthless and you keep the premium $200. So if the stock price rises above $55, so what is married pot? So an investor purchases an asset such as shares of stock and simultaneously purchases pot option for an equivalent number of shares. So a married pot options method protects an investor against a significant drop in the price of the underlying stock. So this expense of the choice can make this strategy excessively expensive if utilized frequently. So the price of pot options varies depending on the strike price in relation to the stock price and the period until expiration. So the method may be effective for low volatility stocks where investors are concerned about a surprise news that will have a negative impact on the stock price. So, long-term investors are unlikely to benefit from married pots since they are not concerned with short-term price changes. So, for example, let's say trader chooses to buy 100 shares of XYZ stock for $20 per share. So, and one XYZ $17.50 pot for $0.50. So 100 shares it times $0.50 equivalent to $50. So with this combination, they have purchased a stock position with a cost of $20 per share, but have also both a form of insurance to protect themselves in case the stock declines below $17.50. So before the pot's expiration, so say the stock price drops unexpectedly to 15 per share, so the traders loss of $5 per share. So on the long position, could be partially offset by the pot's profit of $2.50. So next is call spread. So an investor simultaneously buys calls at a specific strike price while also selling the same number of calls at a high strike price. So a bull call spread is an option strategy used when a trader is betting that an asset will have a limited increase in its price. So the strategy uses two call options to create a range consisting of a lower strike price and an upper strike price. So the bullish call spread can limit the losses of a bull call spread. The goal of a bull call spread first is a bull call spread seeks to profit from a moderate increase in the price of the underlying asset. So if the underlying asset price climbs significantly and reaches or exceeds the higher striker or exercise price at expiration, the approach will maximize profit. However, if the price falls or does not rise significantly, the strategy will suffer a loss equal to the net premium paid to build the spread. So for example, you buy one call option for XYZ company. So with a strike price of $50 for a premium of $3. So the outcome is, so if the stock price stays below 50, both call options expire worthless and you incur a net loss of the premium spread $3 minus $1. So the result is $2. So if the stock price rises to between $50 and $60 and the value of the sold call increases, but the profit is kept by the higher strike price. So if the stock price rises above 60, the maximum profit is achieved difference between strike prices minus net premium paid, so which is 60 minus $50, i-minus na sab siya sa $3 and $1. So the total is $8. That's all.
Good day everyone, my name is Beth and Mabati Rolana, and I will be the one to continue the discussion about the stock option strategies. So with that, we have here the bear put spread. This is a strategies where investors simultaneously purchase put option and at a specific strike price and sell it to a lower strike price. This strategy is used when the trader has a bearish sentiment about the underlying asset and expect the asset price to decline. This strategy offers limited losses and also limited gains. So now, let's move on to protective collar. This is strategy performed by purchasing an OTM or out of money put options and simultaneously writing an OTM call options when you already own a underlying assets. This is often used after a long position in the stock has experienced substantial gain. This allows the investors to have a downside protection as the long put helps lock in the potential sale price. However, the trade-off is that they may be obligated to sell share at a higher price. So let's down to long straddle. Long straddle will be the last one for me to discuss, and with that, this is a strategy where the investors use as they believe that the price of the underlying asset will move significantly out of the specific range, but they are not sure which direction the move will take. Theoretically, this allows the investors to have an opportunity for unlimited gains. On the other hand, losses are also limited to the cost of both option contracts combined.
Good day everyone, I'm the next presenter and my name is Rosmalin C. Dumalaga. So, long strangle. Long strangle is an options trading strategy where an investor buys a call option and put option and is on the same underlying asset with different strike prices, but both options have the same expiration date. So, this is strategy used when the investor expect a significant price movement in the underlying assets but is unsure about the direction of the movement. By buying both a call and a put option, the investor profits from a large price swing in either directions. Long call butterfly spread. So, a long call butterfly spread is an options strategy where an investor buys a call option at a lower price, sells two call options and middle strike price, and buys another call option at a higher strike price, all with the same expiration date. So, this strategy is used when the investor expects the price of the underlying assets to remain stable. It involves limited risk and limited profit potential. The investor profits if the price of the asset stays close to the middle strike price at expiration. Iron Condor. An Iron Condor is an options strategy that involves simultaneously selling an out-of-the-money call option and out-of-the-money put option, while also buying a further out-of-the-money call option and put option. This strategy is used when the investor expects the price of the underlying assets to remain within a certain range. It profits from low volatility and it is neutral strategy. Then, Iron Butterfly. An Iron Butterfly is an option strategy that combines a bear call spread with a bull put spread. It involves selling out of the money call option and out of the money put option, while also buying a call option and a put option at a further out of the money strike. So this strategy is used when the investor expect the price of the underlying assets to remain stable. It has limited risk and a limited profit potential and profits if the price of the asset stay close to the middle strike price at expiration. And that all concludes my presentation. Thank you.
Good day, my name is Christine Shane Cabarles and my topic is price efficiency. So price efficiency refers to the idea that the price of a security or asset is reflected of all data and information that are publicly available to investors, analysts, and the rest of the public at any given time. So price efficiency means that the price of a stock or asset accurately reflects all the information that is available to public, including investors, analysts, and the general public at any given moment. So in simpler terms, it suggests that the current price of a security incorporates all the known information about the security. So this concept implies that it is difficult to outperform the market consistently by trading on public available information, as prices adjust quickly to reflect any new information that becomes available. Now let's proceed to types of price efficiency. So first is weak form efficiency. Is a concept within price efficiency that suggests all past information is already incorporated into current market prices. This implies that historical data cannot be used to predict future price movements. In this form of efficiency, investors cannot gain a competitive advantage over others unless they possess exceptional information that is not publicly available. So this includes news and data that have not been disclosed to the public. Essentially, weak form efficiency indicates that past stock prices or trading volumes cannot be used as a basis for predicting future price movements. So second type is semi-strong form efficiency. Is the idea that all publicly available information such as historical data, financial statements, news, public announcements, and other general information is already reflected at current market prices. So under this form of efficiencies, investors cannot outperform the market using publicly available information alone. So however, an exception exists when an investor has access to private, non-public information, often known as insider information. So this insider data, if legally obtained, can provide an edge over the market as it is not yet reflected in the stock prices. Now for the last type, is strong form efficiency is the most stringent form of efficiency theory. It possesses that all information, whether public or private, is already integrated into current market prices. So in this scenario, no investor can gain a competitive advantage over the market. This means that even with insider information, investors cannot outperform the market as the assumptions is that any relevant information is already known to the public. Strong form efficiency implies that financial markets are so efficient that no individual or entity can consistently outperform the market by trading on the available information.